Briefly give us an update on the recent regulatory changes, tax and the tax laws, what changes have come. It's been an interesting year past. So if you could just brief the audience.
Sure. So, am I audible? Okay. So I think we have seen a drastic shift in regime from the previously applicable venture capital fund regulations. The market, the regulator, everyone has moved towards the alternate investment fund regulations. It's quite engaging to that extent because it now sort of recognizes the different asset classes, the different investment thesis that a different manager would adopt for different funds, etc. So clearly there is some amount of segregation. SEBI's objective clearly has been to sort of focus the incentives to different funds based on the different categories they are in. So clearly you have a category 1 which is sort of accumulating both infrastructure funds, angel funds, VC funds, SME funds, where SEBI believes there should be some amount of encouragement doled out from a regulator's perspective. Category 2, of course, is an omnibus sort of a allocation where you can either do a debt fund or you can do a private equity fund. And category 3 is meant more for hedge fund players. Category 3, of course, is the most interesting because after the mutual fund regulations where you could actively engage in hedge strategies or invest in listed opportunities, for the first time on a private placement basis, there was a separate regime opened up with a hedge strategy. So clearly these are exciting times. The regulator is taking pragmatic view of where the fund managers are looking into, and accordingly they've rolled out a regime very GP friendly, so to speak. Of course, one concern is that the ticket size is 1 crore, which of course can be seen more from a pragmatic perspective, that if you are offering something on a private placement basis, shouldn't the ticket size for investor be good enough so that you only attract the sophisticated players and not people who might consider this as their sole investment program. So clearly you are targeting investors who have that sort of a risk profile to sort of absorb. The other big piece is more on the taxation front. We early in the afternoon sort of heard that how the taxation has been sort of haywire. You had an earlier provision where you allowed a simple case of pass-through to all venture capital funds. Later on, with the introduction of the AIF regime, has the pass-through been limited only to category 1 venture capital funds? The answer technically is now lying under the other provisions of the Tax Act, where the regulator has also SEBI has proactively been asking for pass-through for all other categories of funds, but at the same time the Tax Act clearly allows that if you are a trust and if you are determinate, then you can sort of still make a claim that yes, they should be passed through. And with the recent ITAT order in case of India Advantage Fund, revocability also has become one of the other defensive mechanisms by which as a fund you can always say that there is a pass-through. I think I'll just spend 1 minute on what this revocability means. It does not technically mean that you allow the investor to exit, ask his contribution back, because given if that was to be the position, as a fund manager you'll never know what is the dry powder. Can you draw down that amount or not? The sword of getting a revocation from the contributor always would hang. That is not the case. Unlike a hedge fund, where you can seek a redemption at the NAV and all that, when we say a revocable sort of a contribution in a private equity fund context, what we mean is even a contingent revocation is possible. So you can have a clause in one of your trust deeds or the contribution agreement saying that the contributor as a class has a right to revoke or the trustee has a power to revoke. Even contingent revocability is now accepted. That is what the ITAT order clearly brought out as a part of the revocation. Apart from that, the regulation have also seen a lot of innovations. Now the fund managers, they were struggling at one point in time to raise commitments on a blind pool basis. So what they've done is instead of issuing a separate class of unit to all the investors, they have now one of the structures we have advised on was they did a deal by deal issuance of units. So let's say a deal A had a class 1 unit, a deal B had a class 2 unit. So you approach certain investors for a blind pool sort of a structure. So all the investors get deal 1, 2, 3, 4, all the units. Then you also marketed the fund for that specific deal. So there you only approached a particular investor for a deal 2 or a deal 3 basis. Of course, his commitment still has to be 1 crore plus to qualify as an AIF. But there the innovation was that, okay, your carry structure, your waterfall, has to be a deal by deal basis, but at the same time to cater to your blind pool investor, you have an end of term distribution also. So all those things have been out there in the market.
Thanks, Ruchi. Sharda, my next question I would ask you is, you worked with a lot of angel funds, PE funds. To the audience, as a layperson, I would say, what is the difference and what are the challenges of working for an angel fund compared to a PE or VC fund? If you could just bring that up.
Sure. Most of the audience out here, right at the back, are students. And wouldn't it be nice if you had money getting into your business ideas? And that's primarily what angel investment is kind of helping. If you take Economic Times, one full page kind of set up for startups, and there's so much of a discussion about startups that's happening in India. I was in Israel in May, and Israel is known as a startup nation. And it's a tiny country, and it kind of, the number of startups to the kind of exits is humongous. And the corridor between the US and Israel is so strong. And there are quite a few discussions happening in India at grassroots levels that can make that kind of startup ecosystem really robust. I came into the picture in 2008 when I set up Novajuras. And from 100 deals, sub-100 deals, not the ticket sizes, but the number of deals. From then to 2014, we are seeing about 3 to 4x of it. There's huge action, and most of this action that I see are in technology space. And I think it's for a reason, because it takes very little money to now set up a business in technology because of cloud computing and many other newer technologies that's coming. It also means that the disproportionate growth that you can see happens in a technology space. So here is something, an angel coming in, investing small sums of money, and boom, the startup kind of really grows fast. And therefore, the discussion about the exits that kind of comes in, and we are seeing those exits, something where it's an accelerator who's invested about 20 to 25 lakhs, and now seeing about 5 crores of return at a Series B, Series C level. We're seeing those, and a good amount of those exits are also being captured in mainstream media. And I think that is emboldening many of the younger generation to kind of see starting up as an alternative and not just taking up a job. And that to me is the excitement.
Sure. But what would be the essential regulations, how they differ and how the terms differ between a PE and VC, if you could just share?
Sure. So we have the angel fund. So we have the 3 categories, and I think all of you have heard it since morning. You have the category 1, which is the VC, and a subset of it is the angel investment. And if I take the whole lot of the angel and the VC is where I see a lot of action. And are the terms, so in setting up, we have SEBI segregating the angel fund as a separate fund with 25 lakhs of ticket size versus the 1 crore that Richie was talking about. So it enables smaller investment as much as 50 lakhs into a company, but it has to be in a company lesser than 3 years, lesser than 25 crores of turnover. But then there are many nuances that come by saying, 3 years of lock-in, 49 people, all of that, which is the difference from the larger fund.
Thanks, Chad. Sudhir, you are somebody who's actually worked, who's run a fund of his own, and like the previous panel. But what are you seeing as emerging challenges in the fund terms which are being offered, the evolution, or the practical issues which a budding PE fund or what you could look at?
I think the most difficult part is to align the investor, yourself, and your investee. And those 3 are normally in different trajectories. To get these aligned is the first and most important thing if you want to ever set up a fund. So it of course naturally starts with yourself, because you're propagating the idea that you're going to be competent to manage somebody else's money, to be able to be competent to give it to somebody else who's going to use the money, So you're sort of caught, unless, like the previous panelist said, unless you can be passionately excited, involved in that enterprise or developing that enterprise, there is very little chance that you'll make money actually. And more so in a stage which is called the early stage. What Sharda is referring to is the excitement is in starting up, but money is made not just in starting up. Money is made if you actually are of value to your customers. So as far as I was concerned, I've always sought to look at people who are really interested in their customers. Whether it was Dr. V, who after retiring as a government doctor decides to get into the area of avoidable blindness and then becomes the largest surgery center in the world. And there are n number of examples in India. Or when, back in 1994, when we were associated with Infosys going public, it was a very small firm in those days. It was just 165 people working there. But dealing with Mr. Murthy in those days, or dealing with Mr. Nilekani in those days, and seeing what they were trying to build was an example for any of us to then back. So we would put our money either because it was a publicly listed company and it allowed us to go and invest in those companies, but they were pretty much what they refer to today as a startup. It was sub 30 crores in size, 3 crores of profit, I think, unknown. It had a few clients. India was not the destination. India was not the place for technology. India was a shipper of bodies in those days. But that's what for us, having seen that for 20 years, and having seen that industry mature into a $100 billion industry, for us when we set up a fund to look at the possibility of intellectual property coming out of India, our excitement is the fact that there are 3 million people employed in this sector right now, who go every morning to work and come back, with a tag in a bus maybe. But some of them are deeply excited about what they're doing, how globally connected they are. They're sitting on blogs, they're sitting in forums, they're sitting absolutely connected with an East European, an American, maybe a Japanese guy. And when I go to those so-called garages, where there are 10 people huddled, trying to build an enterprise, they need the money and they need the support. Support in terms of access, support in terms of connecting them to larger enterprises, if they're in enterprise software. The ability to understand markets and customers, because they may not have done that. They may understand technology, but they may not understand the business side. They may not understand finance, because he may be a computer sciences grad. He may be excellent in data sciences, but he may not understand business. Our effort is really surrounded in looking at the gaps that these teams have got. And those gaps have to be filled by other co-founders or other employees. And between effort and result, there's time. And these costs have to be paid for. That's what we invest into. So when we set up a fund, we need to be aligned to the understanding of where is this money going, how is it going to be used, how will customers pay for what you're doing, whether it's a taxi ride, whether it's a bottle of water, whether it's a piece of code. Somebody has to pay for what you're doing, because it's a business proposition. If it were a charitable proposition, then, as he said, then I must have a donor who comes across to my doorstep, and I don't mind taking the donation. In a business enterprise, we expect customers to pay. Between the time the customers are paying, or we've had enough customers, enough to pay for the proposition that we have, they need to be funded. So our fund, or any fund for that matter, must have that clarity, must have an investment thesis. Around that investment thesis are investors who you go after, who are aligned to that thesis, who back that thesis. It could be agriculture. I think India is going to continue, in the next 25 years, not much will move the needle. 40% of the consumption will be food. So you could be setting up a fund around agriculture and just focused, and there are funds that are just focused on agribusinesses. The bank that I'm on the board of is pivoting itself into an agri bank, which is focused on agriculture. And we make a lot of money there because farmers need money. So it's not that it's a priority sector loan, so it doesn't make money. You could either lend or you can put equity there. In terms of fund terms, if you're a good asset manager, if you're a good manager, you'll get paid. I just heard this morning that a graduate from IIT Madras got picked up for $250,000. But I don't think it was just a student of IIT. My sense is that that student was doing something incredible and was worth $250,000 as a first job. And if you're not good enough, I don't think you should get paid even 30,000 rupees. So the key is, whether I'm a fund manager, I'm a manager of my competency being offered to a client. My limited partners, my partners in the fund, the people who give us money to look after it, are my customers. They give me the money so that I can make money. You know, in the last panel, they said exit is a bad word. It's not a bad word. I exit a role. Each of us have gone to college. We exited college. There's nothing bad with that. We went to postgrad. We exited postgrad. We took our first job. We may have exited our first jobs. None of which was less passionate. I was very passionate when I was a student. I'm as passionate as my first job. I'm as passionate as I am today in what I seek to do. So if I come back to what you're saying, fund terms, the best VCs in the world get 3.5% and 35% carry. So that's the best case. And they talked about in the morning that you don't get more than 1 in 10 as another end of the game. So if you're commodity, then yeah, I don't even think you should get 1 in 10. But if you give superlative returns, then yes, you should get a fair, and it's as high as 3.5, 35 at the top end of the bracket. That's as far as fund terms are concerned.
Sure.
Setting up the fund, I repeat, just set it up like your life. Just be clear-headed.
As Richard said in the introduction, we've
That you're providing value to the environment, to society at large, to human beings. If you do that, I don't think you have a problem. You can set up a fund also. Fund is just a nomenclature, a vehicle to exercise your life's purpose. So that's how I see it. As she said, it's exciting out there when you go out to colleges, and I go and address the entrepreneurship cells. I see the excitement in multiple zones. I see the excitement of a 50-year-old who doesn't want to retire, and I'm willing to back that person. It doesn't matter. Because a 50-year-old is not somebody, startup doesn't mean that you have to be a certain age group or anything of that sort. At your early stage of doing something, if we think we can help you monetize your idea,